All right, let's dive into a part of the investing world that, doesn't always get the big, flashy headlines. Bond ETFs. But here's the thing. Really getting a handle on these can be a total game changer for building a portfolio that can actually weather the storms. So let's get right into it.
So let me ask you this. Think about your portfolio for a second. If your stocks are the engine, the part that's driving all the growth and pushing you forward, what's your shock absorber? What's the thing that's smoothing out the ride when the road gets all bumpy and chaotic? That's exactly the role we're going to explore, and it just might be the piece you've been missing.
Okay, so let's start with the absolute basics. What in the world is a bond ETF? We're going to pull back the curtain and demystify this thing.
The easiest way to think about a bond ETF is to picture a basket. Now, instead of you having to go out and painstakingly pick out individual bonds one by one, you can just buy this one basket. And inside that basket are already hundreds, maybe even thousands of different bonds. Could be from the government, could be from big corporations. And the best part, you buy and sell this entire basket on a stock exchange, just like you would a share of Apple or any other company. It's that simple.
And this, right here, this really highlights the massive leap forward we're talking about. I mean, the old way of buying individual bonds was just complicated. It took a ton of research, a lot of capital, and trying to get properly diversified was a huge headache. Bond ETFs completely changed the game. They're simple, you can get started with a much smaller amount of money, and you get instant diversification the second you hit buy.
So that covers the what. But now let's get into the why. I mean, why would you, as an investor, even want to add these to your portfolio? Well, to really answer that, we have to look at both sides of the coin. The incredible benefits, and of course the risks you absolutely need to know about.
Okay, so there are three core benefits that really make these things shine. First up, regular income. All those interest payments from all the bonds in the fund, they get passed along to you, usually as a nice monthly or quarterly dividend. Second, and this goes right back to our shock absorber analogy, they're just generally less volatile than stocks. They can bring a real sense of stability when the stock market is going wild. And third, diversification. And this is so crucial. Bonds often dance to a different tune than stocks. So when your stocks are having a bad day, your bonds might be holding steady or even going up, which helps cushion the whole portfolio.
But, just like any investment out there, there's always a flip side. Being a smart investor means you don't just look at the shiny upside. You have to understand the potential risks too. So let's be totally transparent and break down what you need to be watching out for.
So there are three main risks to keep on your radar. First is interest rate risk. Just think of it like a seesaw. When interest rates out in the market go up, the price of older, existing bonds tends to go down. That means the value of your ETF can and will fluctuate. A key term here is duration. The higher the duration, the more sensitive your fund is to these changes. Second is credit risk, which is basically the chance that a company or government can't pay back its debt. Now, the beauty of an ETF is that it helps soften this risk. Because you own so many different bonds, if one defaults, it's not a catastrophe. And finally, you've got inflation risk, the classic risk that your returns just don't keep up with the rising cost of living, making your money worth less over time.
And here is a really critical difference you have to understand. See, if you buy an individual bond, it has a maturity date, a specific day when you're supposed to get your original investment back. A bond ETF doesn't have that. It's a perpetual fund. The fund manager is always in there, buying new bonds and selling old ones to stick to the strategy. This means you can hold it forever, but you never get that single, final payday where your principal is returned all at once.
Okay, so we've nailed the what and the why. Now for the most practical part, the how. How do you actually put these powerful tools to work to help you reach your financial goals?
Bond ETFs are definitely not a one-size-fits-all kind of deal. They come in a few different flavors. If your number one goal is just safety and stability, you'd probably look at government bond ETFs that hold U.S. Treasuries. Those have the lowest risk. If you're okay taking on a bit more risk to get a higher income stream, then corporate bond ETFs might be your speed. And for folks in higher tax brackets, municipal bond ETFs can be super attractive because the income they generate is often completely free from federal taxes.
So, to kind of wrap it all up, who is this really for? Well, bond ETFs are fantastic tools for anyone who's looking to generate a steady stream of income. They're also perfect for investors who feel like they're way too heavy in stocks and want to diversify. And they're especially popular for people who are getting closer to retirement, when the focus shifts a little from high growth to preserving what you've built.
So there you have it. We've unpacked the what, the why, and the how of bond ETFs. We've seen how they can act as that all-important shock absorber for your portfolio, giving you income, stability, and diversification. The only question left is the one you have to answer for yourself. So what role are bonds going to play in your financial story?